The core laws governing speculation have remained unchanged for over a century, defying the rapid evolution of technology, data accessibility, and trading platforms. Jesse Livermore, the legendary speculator known as the Boy Plunger, codified these laws not as abstract theories but as ironclad rules forged in the crucible of real-world market booms and devastating crashes. He understood that success in the market is fundamentally a mastery of human psychology and systematic discipline. Turning the chaotic art of speculation into a rigorous, profitable profession. By internalizing and strictly applying Livermore's 15 principles, any serious trader can transform their approach from reactive gambling into calculated professional maneuvering. The markets of 1907 or 1929 might seem vastly different from the high-frequency trading environment of today, yet the motivations driving price movement, greed and fear, are eternal constants. Livermore's genius lay in recognizing that the mechanical aspects of trading are secondary to the psychological and strategic framework applied by the individual trader. These 15 rules serve as a comprehensive, timeless framework designed to impose discipline where human nature naturally encourages reckless abandon. They represent the distilled wisdom gleaned from decades of spectacular wins and agonizing educational losses, offering a blueprint for enduring market success. Applying these 15 principles transforms speculation from a game of chance into a systematic, repeatable profession, demanding the same rigor as engineering or law. The principles cover the entire spectrum of trading activity, ranging from initial market identification and trend analysis to critical capital preservation and, most importantly, psychological mastery. Ignoring even one of these pillars inevitably introduces structural weakness into the trading strategy, leading to eventual, often catastrophic, failure. The journey toward becoming a professional speculator begins not with finding the perfect stock, but with adhering strictly to an unwavering set of rules. Principle 1. Always trade with the line of least resistance. The fundamental error most beginners make is attempting to impose their personal opinion onto the market, believing they know better than the aggregated wisdom of millions of participants. Livermore taught that the market always has a primary direction, known as the line of least resistance, and the speculator's sole task is to identify and follow this dominant trend. If the market is clearly bullish, attempts to short based on perceived overvaluation are almost always premature and costly, resulting in being continually squeezed out of the trade. Fighting this primary trend is not only financially exhausting, but also mentally debilitating, destroying the necessary confidence required for successful speculation. Identifying the primary trend requires observing price action over extended periods, focusing on the formation of higher highs and higher lows in a bullish market, or the inverse in a bearish one. Livermore stressed that you should never assume a trend has reversed until the market itself provides undeniable evidence through definitive price breakdowns or breakouts. Attempting to pick the exact top or bottom is a fool's errand that guarantees capital erosion through premature entries and unnecessary risk exposure. True speculative profit is found in riding the established, confirmed momentum until the market visibly exhausts itself. When the market is moving sideways, lacking a clear direction, the line of least resistance is horizontal, signaling a time for observation rather than commitment. Capital should be conserved during these consolidation phases, as attempting to trade the noise within a narrow range often results in whipsaws and frequent small losses. The professional speculator recognizes that waiting for the market to declare its next major move is a trade in itself, preserving capital for the inevitable, high-conviction opportunities. Always ask yourself, which direction will require the least effort for the price to move significantly? This principle also implies an understanding of relative strength, meaning that the strongest stocks in the strongest sectors will offer the greatest returns when the overall market trend is positive. Conversely, during a bear market, the weakest groups will decline the fastest, offering the best opportunities for short selling. The line of least resistance applies not only to the general indices, but also to the individual equities chosen for speculation. Trading against the prevailing wind, whether broad or specific, is a recipe for guaranteed frustration and mounting losses. Principle 2. Wait for confirmation before acting. The impatient speculator often jumps into a position based on a hunch, a news report, or a feeling that the price is about to move, which is a dangerous form of anticipation. Livermore insisted that the market must confirm your thesis through actual price movement before you commit significant capital. This confirmation often occurs at a pivotal point, which is a price level where a stock breaks out of a previous range or clears a significant barrier, signaling that the move is genuine. Acting before this confirmation means assuming unnecessary risk, as the anticipated move may simply fail to materialize, leading to immediate losses. A pivotal point is not merely a random price level. It is a critical juncture where the forces of supply and demand are visibly shifting in favor of one side. Waiting for the stock to trade decisively past this point validates the underlying momentum and proves that the larger market forces are now aligned with the trade direction. Livermore learned that if he bought a stock at a pivotal point and it immediately began moving in his favor, the probability of a successful large move increased dramatically. Conversely, if it hesitated or immediately fell back, the signal was false, and the position should be exited swiftly. Never chase a stock once it has already moved substantially past its pivotal point, as this violates the discipline of waiting for the optimal entry. The professional approach involves setting up positions precisely at these critical levels, ensuring the entry price offers the maximum potential reward relative to the minimum immediate risk. Emotional trading often involves buying out of fear of missing out, FOMO, which inevitably leads to purchasing near the top of a short-term move, leaving no room for protective stops. Patience is the ultimate discipline when applying the confirmation rule. The waiting process is often the most difficult part of speculation, as it requires resisting the urge to constantly be active in the market. Livermore noted that money is made not by constant trading, but by sitting still and waiting for the undeniable setup to materialize. When the market action confirms the trend by decisively clearing a pivotal point, the commitment should be swift and decisive, but never before the signal is clear. This methodical approach ensures that the market is leading the speculator, rather than the speculator attempting to lead the market. Principle 3. Do not average down. Perhaps the most universally violated rule by amateur traders is the disastrous practice of averaging down on a losing position. When a stock moves against the speculator, adding more shares at a lower price simply compounds the initial error, increasing the exposure to a trade that the market has already declared wrong. Livermore viewed averaging down as the ultimate psychological trap, driven by hope that the price will recover just enough to break even, rather than admitting the mistake immediately. This hope often transforms a small, manageable loss into a catastrophic, portfolio-destroying event. If a stock is bought at $10 and falls to $8, buying more shares at $8 doubles the capital at risk in a trade that is already demonstrating negative momentum. The professional approach dictates that if the initial test of the position proves wrong, the position must be closed, and the capital preserved for the next, better opportunity. The market is never obligated to recover simply because the speculator needs it to, and holding on to a losing position is a sign of stubbornness, not strategy. Admitting a mistake quickly is the hallmark of professional risk management. Averaging down violates the fundamental principle of cutting losses quickly, as it increases the size of the potential loss exponentially. Instead of viewing the loss as a temporary setback, the speculator must recognize it as market feedback indicating that their timing or analysis was flawed. Livermore famously stated that there is nothing more disheartening than having a bad position turn worse after adding to it, trapping the speculator in an emotional and financial bind. The correct time to average is only when scaling into a profitable position, never when nursing a failure. The discipline required to avoid averaging down must be absolute, treating the initial stop-loss level as sacred and non-negotiable. If the stock hits that level, the trade is done, regardless of how cheap the stock might appear relative to its past highs. Speculators who average down are essentially gambling that the market will validate their original flawed assessment, a bet that rarely pays off in the long run. Professional trading involves accepting small, frequent losses as a necessary cost. rather than risking large, infrequent blow-ups caused by doubling down on errors. We have discussed Livermore's foundational principles emphasizing trend identification and disciplined entry confirmation. However, successful speculation requires more than just recognizing the trend. It demands a deep understanding of the structural forces driving accumulation and distribution that underpin these price movements. For those serious about elevating their market analysis beyond mere trend following, a powerful methodology exists that complements Livermore's focus on pivotal points in market structure. This is the Wyckoff method, a systematic approach pioneered by Richard Wyckoff, a contemporary of Livermore, which provides the visual tools necessary to understand institutional activity beneath the surface. If you are looking to truly master the cycles of the market, identifying the telltale signs of institutional buying, accumulation, before a major markup, or institutional selling, distribution, before a sharp markdown, then you need to explore the Richard Wyckoff Trading Methods channel. This dedicated resource offers in-depth analysis of Wyckoff's schematics, volume studies, and supply-demand logic, transforming abstract market concepts into practical visual trading signals. It bridges the gap between simply following the trend and understanding the mechanics of why the trend is starting or ending, giving you a massive analytical edge. Start your journey into mastering market structure today and integrate Wyckoff's deep insights with Livermore's discipline. The link to the Richard Wyckoff Trading Methods channel is available right now in the description below. Principle 4. Focus on the leading stocks. Livermore discovered early in his career that real speculative fortunes are made in the market leaders, those stocks that define the sector and exhibit the strongest relative strength. These are the equities that show the greatest velocity and momentum when the market is moving, offering the largest potential percentage gains. Speculating in stagnant, lagging, or secondary stocks is a waste of time and capital, as they rarely possess the explosive power necessary for significant speculative profit. A professional focuses their limited attention and capital only on the best opportunities available. Identifying the leaders involves looking for stocks that are consistently outperforming their sector peers and the general market indices during bullish phases. These stocks often hit new highs first and maintain their upward trajectory with strong, consistent volume, signaling robust institutional support and public enthusiasm. Trading these strong performers ensures the speculator is positioned where the maximum amount of money is flowing, maximizing the potential return on every unit of risk taken. Never commit capital to a stock simply because it is cheap or has been beaten down unless it shows clear signs of becoming a new leader. The futility of speculating in lagging equities lies in their inherent inability to sustain a significant upward move, often due to underlying fundamental weakness or lack of broad investor interest. Even if the overall market rises, these stocks tend to move sluggishly, tying up capital that could be generating substantial returns elsewhere. Livermore advocated for a concentrated portfolio focused on a small number of true market leaders rather than a diversified basket of mediocre performers. Focus allows for deeper analysis and better monitoring of pivotal points. A key element of this principle is understanding the sectoral rotation that drives market leadership. Leadership is not static. It shifts between technology, energy, healthcare, or financials depending on the economic cycle. The successful speculator constantly monitors which sectors are attracting the most capital and identifies the one or two strongest stocks within those leading groups. By focusing exclusively on these elite performers, the speculator aligns themselves with the most powerful forces in the financial landscape, maximizing efficiency and potential profit. Principle 5. Let the market confirm your patience. Livermore often stressed that his greatest profits were made not by acting, but by systematic waiting and sitting still once a position was established correctly. The temptation to constantly trade, to be active every day, is a psychological flaw that destroys capital through transaction costs and poorly timed entries. Patience is the ultimate virtue in speculation, allowing the market to develop optimal setups and confirming that the existing profitable positions are still valid. The market owes the speculator nothing, and forcing action is always a costly mistake. Before committing capital, the speculator must observe the market with detached objectivity, analyzing the overall trend, the sectoral strength, and the individual stock's movement relative to its pivotal points. This observation phase, sometimes lasting weeks or months, is crucial for building the necessary conviction required to commit large amounts of capital when the signal finally arrives. Impatience leads to premature entries, often resulting in small losses that erode confidence and capital reserves before the real opportunities arrive. Waiting is an active part of the strategy. Once a profitable trade is established, patience takes on a new form. The discipline to sit through normal market fluctuations without panicking and selling prematurely. Livermore recognized that big money is made in the middle of major moves, and constantly jumping in and out destroys the potential for massive gains. The market must confirm the reversal through definitive action before the position is closed, forcing the speculator to overcome the psychological fear of giving back paper profits. Let the profits run until the market signals it is time to exit. The market confirms patience by rewarding the speculator who waits for the perfect setup, often characterized by high conviction and low immediate risk. Conversely, the market punishes the impatient trader with frequent losses and emotional exhaustion. Livermore was known for periods of intense activity followed by long stretches of quiet observation, a rhythm dictated by market conditions, not personal desire. This cyclical approach, waiting, acting decisively, then sitting still, is central to professional speculation. Principle 6. Cut losses quickly. This principle is the cornerstone of all professional speculation and is arguably the most critical rule for long-term survival in the markets. Livermore asserted that the first step in managing a position is defining the point at which the initial analysis is proven wrong, and then exiting immediately upon reaching that level. Accepting small losses is a necessary cost of doing business, analogous to paying insurance premiums, protecting the capital base from catastrophic erosion. Never allow a small loss to morph into a large, portfolio-threatening disaster. Defining the stop-loss point must be done before the trade is entered, based on technical analysis of the pivotal point or support level, not based on a random percentage. Once the market moves against the position and violates this predetermined stop, the speculator must execute the exit without hesitation or emotional debate. The moment a speculator starts hoping the price will recover, they have abandoned professional discipline and entered the dangerous realm of gambling. The market is always right, and arguing with it is costly. The ability to cut losses quickly is a direct measure of the speculator's emotional discipline and commitment to their rules. Many traders hold on to losing positions because they fear realizing the loss, allowing pride and stubbornness to dictate their actions. Livermore learned that the cost of realizing a small loss is negligible compared to the mental and financial burden of holding a deeply underwater position, which paralyzes the ability to seize new opportunities. Preservation of capital is always the primary objective. Cutting losses quickly ensures that the speculator maintains sufficient capital reserves and mental clarity to continue trading effectively when the next high-probability setup appears. Livermore often stated that his most painful lessons came from positions where he violated his own stop-loss rules, holding on against all logic until the losses became unbearable. Professional speculators understand that every trade is merely a test of a thesis, and if the test fails, the experiment must be terminated immediately and without regret. Principle 7. Let profits run. While cutting losses quickly protects the downside, the ability to let profits run is what generates the massive returns necessary to offset the inevitable series of small losses. Livermore observed that most speculators make the mistake of selling profitable positions too early, driven by the psychological fear of seeing paper gains evaporate. This premature selling severely limits the potential return, preventing the speculator from capitalizing on the powerful momentum moves that define market leaders. True profit maximization requires patience and conviction in the established trend. The fear of giving back gains is a powerful psychological hurdle that must be overcome through strict adherence to the trend-following rules. A position should only be closed when the market action itself signals a definitive reversal, such as violating a crucial trend line, breaking a major pivotal point, or exhibiting clear distribution patterns on high volume. Until that definitive signal appears, the professional speculator must sit tight and allow the momentum to continue carrying the position higher. Do not substitute personal anxiety for objective market signals. Livermore found that the biggest profits often came from the positions that seemed easiest, the ones that moved immediately in his favor and continued to climb without significant pullbacks. These were the trades where his initial analysis and timing were impeccable, aligning perfectly with the line of least resistance. Holding these winners, even when they seemed overextended to the impatient eye, was the secret to capturing the substantial gains needed to fund the entire speculative operation. A speculator must be willing to ride the wave until it unequivocally breaks. The mistake of selling too soon means the speculator is constantly making small, frequent profits that are easily wiped out by the inevitable small losses, leading to stagnation. By letting profits run, the speculator ensures that the few large winners dominate the trading record, providing the asymmetric return profile required for long-term speculative success. Discipline dictates that just as stops are mechanical on the downside, the profit-taking mechanism must also be mechanical, triggered only by objective trend reversal signals, not by emotional fear. Principle 8. Use trial and error to establish position size. Livermore believed that entering a full position immediately was reckless, as it exposes the maximum amount of capital before the market has confirmed the trade's validity. Instead, he advocated for entering a position with a small initial testing lot to gauge the immediate market reaction. This trial balloon allows the speculator to test the waters, ensuring that the timing is correct and the stock behaves as anticipated relative to its pivotal point. If the test lot immediately moves in the intended direction, the thesis is confirmed, and the speculator can proceed confidently. If the initial testing lot shows a profit, the speculator can then scale into the full position, adding subsequent lots at defined price intervals as the trend progresses favorably. This scaling process not only reduces the risk profile of the overall trade, but also ensures that the average entry price is protected by the initial paper profit. By the time the full position is established, the market has already validated the trade, providing a cushion against minor pullbacks and increasing the conviction level dramatically. Scaling in only on strength is essential. Conversely, if the initial testing lot immediately moves against the speculator and hits the predetermined stop-loss level, the loss is minimal, and the experiment is quickly terminated. The small loss incurred by the test lot preserves the majority of the intended capital for the next opportunity, preventing a large commitment to a failed trade. This methodical approach removes the emotional pressure of having too much capital at risk prematurely, allowing for clearer decision-making throughout the trade lifecycle. Position size is managed dynamically. The principle of trial and error emphasizes that position sizing is a function of market confirmation, not arbitrary commitment. Livermore never committed his entire intended capital at one price, recognizing that precision timing is impossible to achieve consistently. By using test lots and scaling into strength, the speculator ensures that their maximum capital exposure is reserved only for the highest conviction, already profitable trades. This strategic scaling is a defining feature of professional money management. Principle 9. Always maintain a cash reserve. A speculator who is fully invested at all times is vulnerable, lacking the flexibility to capitalize on unexpected opportunities or to ride out unforeseen market volatility. Livermore learned that maintaining a substantial cash reserve, sometimes comprising 50% or more of total capital, is crucial for both offense and defense. This reserve acts as dry powder, ready to be deployed when a truly exceptional high-probability setup materializes, often during periods of market panic or significant correction. Liquidity is the speculator's greatest asset. The cash reserve provides the mental comfort necessary to hold successful positions through normal market corrections without panic selling. Knowing that there is ample cash available to weather short-term storms reduces the psychological pressure to liquidate profitable trades prematurely. It also ensures that the speculator is never forced to sell assets at unfavorable prices simply because they need liquidity for margin calls or other unexpected demands. Financial flexibility translates directly into emotional stability. Market opportunity does not adhere to a convenient schedule. The best chances often arise quickly and without warning, demanding immediate and decisive capital commitment. A fully invested speculator is forced to watch these opportunities pass by or, worse, liquidate existing positions at a disadvantage to raise funds. Livermore emphasized that the ability to strike hard and fast when the signal is perfect requires ready capital, conserved diligently during periods of uncertainty or poor market structure. Maintaining a cash reserve is a counterintuitive discipline, particularly when the market is roaring and the temptation to be fully invested is highest. However, the professional speculator recognizes that the cash reserve represents preparedness for the inevitable market correction or the rare perfect setup. It is a strategic tool that allows the speculator to trade from a position of strength, ensuring they are never forced into reactive or desperate trading decisions driven by lack of liquidity. Principle 10. Avoid overtrading and constant activity. Overtrading, the compulsion to be constantly in and out of the market, is one of the fastest ways to erode capital, confidence, and discipline. Livermore recognized that this activity is often driven by emotional needs such as boredom or the desire for daily excitement rather than objective market signals. The market does not provide a high probability opportunity every day, and attempting to force trades during periods of consolidation or uncertainty is detrimental to long-term success. Patience precedes profit. The costs of overtrading extend beyond mere commissions and fees. They include the accumulation of small, frequent losses that erode capital reserves incrementally. More importantly, constant activity clouds judgment, preventing the speculator from maintaining the detached, objective perspective necessary for identifying true pivotal points. When a speculator is emotionally invested in numerous small, active trades, they lose the ability to focus on the major, life-changing moves. Quality always trumps quantity in speculation. Livermore's experience taught him that market conditions are often unfavorable for speculation, requiring long periods of observation where the best trade is no trade at all. During these waiting periods, the amateur trader becomes restless and invents reasons to enter the market, while the professional conserves energy and capital. The speculator's goal is not to maximize the number of trades, but to maximize the profitability of a select few, high-conviction trades executed at optimal times. The discipline to avoid overtrading requires the speculator to define their trading criteria so strictly that only a few setups per month or even per quarter meet the requirements. By raising the bar for entry, the speculator forces themselves to be selective, conserving mental energy and capital for the truly exceptional opportunities. Livermore was a proponent of focused, large-scale action when the trend was clear, offset by long stretches of profitable inactivity when the market lacked direction. Principle 11. Control the twin evils of speculation: hope and fear. Livermore identified hope and fear as the two most destructive emotions that corrupt speculative judgment and lead to catastrophic errors. Hope is the primary villain when a position is losing. The speculator clings to the hope that the price will recover, preventing the necessary action of cutting the loss quickly. This irrational optimism transforms manageable losses into devastating ones, violating Principle 6. The market requires objective realism, not emotional wishing. Fear, conversely, is the primary villain when a position is profitable. The speculator fears giving back paper gains, leading to premature selling. This fear prevents the speculator from letting profits run, violating Principle 7 and severely capping the potential returns. The successful speculator must eliminate hope when a position is going against them and eliminate fear when a position is moving in their favor. This psychological detachment is essential for mechanical execution of the trading plan. The professional speculator replaces hope and fear with objective rules and mechanical execution. When a stop is hit, hope is irrelevant. The position is closed. When a trend is confirmed, fear is irrelevant. The position is held until a technical reversal signal appears. This requires an almost robotic adherence to the plan, recognizing that the market is designed to exploit human emotional vulnerabilities. The rules exist precisely to counteract these innate, destructive psychological tendencies. Livermore noted that the moment emotion enters the decision-making process, the speculator ceases to be a professional and reverts to a gambler. Mastering hope and fear is not about suppressing feelings entirely, but about recognizing them and preventing them from influencing trading decisions. The discipline required to manage these twin evils is often more challenging than mastering the technical analysis itself, representing the final frontier of speculative mastery. Principle 12. Never rely on tips or inside information. Livermore learned through bitter experience that trading based on external tips, rumors, or unverified inside information is a path to consistent failure. Tips are inherently biased, often originating from individuals with ulterior motives or simply poor judgment, and they distract the speculator from objective market action. The only reliable information is the price and volume action displayed directly on the tape, or the modern chart, which reflects the aggregated reality of the market. Trusting outside sources introduces unnecessary emotional bias. When a speculator follows a tip, they surrender control and responsibility for the trade to an external party, making it impossible to apply disciplined risk management. If the trade goes wrong, the speculator lacks the fundamental conviction based on their own analysis necessary to cut the loss quickly. Conversely, if the trade goes right, the speculator learns nothing about market mechanics, fostering a dangerous dependency on unreliable external guidance. Self-reliance is mandatory for professional speculation. The price action itself is the ultimate indicator reflecting the true intentions of the institutional players and the underlying supply and demand dynamics. If a stock is fundamentally strong and poised for a move, the price and volume will show the necessary confirmation at the pivotal point, regardless of any rumors circulating. Focusing solely on objective market data eliminates the psychological burden of trying to verify or second-guess external noise. The tape tells the truth. Livermore concluded that the only way to achieve consistent success is by developing and trusting one's own independent judgment based on sound principles of trend identification and technical analysis. Trading based on tips transforms speculation into gambling, where the outcome is controlled by external, opaque forces. The professional speculator relies exclusively on their rules and their charts, treating all external advice with extreme skepticism. Principle 13. Study your own mistakes. The path to speculative mastery is paved with losses, but the true value of these losses lies in the lessons they provide, provided they are rigorously analyzed. Livermore emphasized the critical importance of keeping detailed records of every trade, especially the losing ones, to understand precisely where the analysis or execution failed. Without this systematic post-mortem review, the speculator is condemned to repeat the same expensive errors indefinitely. Learning from mistakes is the engine of professional growth. Analyzing mistakes involves asking specific, objective questions. Was the loss due to violating the stop-loss rule? Did I enter prematurely, failing to wait for confirmation? Did I average down on a loser? Was the position size too large? The goal is to identify the behavioral or analytical flaw, isolate it, and implement a preventative measure in the trading plan. Simply accepting the loss without analysis is throwing away valuable, hard-won market tuition. Livermore noted that many of his most significant breakthroughs came immediately following periods of major financial loss, precisely because the severity of the loss forced him into deep self-reflection and rule modification. The pain of the mistake serves as a powerful motivator to enforce stricter discipline moving forward. This dedication to continuous improvement, viewing every failed trade as a data point for refinement, separates the amateur from the professional. The meticulous study of past mistakes builds the experience base necessary to recognize recurrent patterns of failure and avoid them in the future. This self-accountability is non-negotiable. The speculator must be their own harshest critic, ensuring that emotional biases are rooted out systematically. By documenting and analyzing failures, the speculator transforms random losses into structured educational lessons, incrementally improving the overall profitability profile. Principle 14. Do not speculate in too many stocks simultaneously. Effective speculation requires focused attention, allowing the trader to monitor the critical pivotal points and the underlying behavior of each position constantly. Livermore warned that attempting to track and manage too many different stocks simultaneously dilutes attention, leading to missed signals and execution errors. The inability to give adequate focus to a large, disparate portfolio severely compromises the ability to act decisively when a stop is hit or a profit signal is given. Concentration is key to control. A small, concentrated portfolio of market leaders, as dictated by Principle 4, allows the speculator to truly internalize the behavior and rhythm of each stock. This intimate knowledge is essential for distinguishing between normal market volatility and a genuine breakdown or breakout. When tracking too many securities, the speculator operates superficially, relying on generalizations rather than deep, contextual understanding of the price action. Discipline demands focus. The core difficulty in monitoring numerous positions lies in the timing of entry and exit signals. If a speculator is tracking 20 stocks, the probability of missing a crucial pivotal point on one of them simply due to divided attention becomes very high. Missing a stop by a crucial few minutes can transform a small loss into a major one, while missing an optimal entry point means missing the entire move. Efficiency is maximized by limiting the scope of activity. Livermore's successful periods were always characterized by focused, concentrated speculation in a few key sectors where the trend was undeniable. He understood that managing risk effectively requires constant, minute-by-minute awareness of the capital at risk and the immediate market signals for each position. By limiting the number of stocks, the speculator ensures that every position receives the professional level of attention required for disciplined management. Principle 15. The human element remains constant. The final and perhaps most profound of Livermore's principles is the recognition that the fundamental nature of market speculation remains eternally the same because it is rooted in unchanging human psychology. Regardless of whether trading occurs via ticker tape or algorithmic high-frequency systems, the forces of greed, fear, hope, and pride drive price action just as powerfully today as they did a century ago. This constancy means that the 15 principles are timeless, transcending technology. The market is simply a reflection of collective human emotion, magnified and expressed through price fluctuation. Understanding this constant psychological foundation provides the speculator with a crucial philosophical anchor, preventing them from being swept up in the latest technological fads or market narratives. What worked for Livermore, identifying the trend, cutting losses, and controlling emotion, works today because human nature has not evolved. The rules of the game are stable. This principle instills humility, reminding the speculator that market mechanics are often predictable, but human reactions are highly volatile. The professional speculator relies on the predictable recurrence of psychological patterns, such as panic selling at bottoms and euphoric buying at tops, to inform their systematic entries and exits. They do not fight the human element. They capitalize on its predictable irrationality by adhering strictly to their rational rules. Livermore's legacy is not just a collection of trading tactics, but a philosophical framework centered on psychological mastery. By accepting that the human element remains constant, the modern speculator gains confidence that disciplined adherence to these 15 rules will always provide an enduring edge over the emotionally driven masses. The market will always offer opportunities to those who are patient, disciplined, and systematic in their approach. Jesse Livermore's extraordinary success was ultimately built not on superior intellect or secret information, but on unyielding discipline, systematic observation, and the supreme patience to wait for the perfect setup. He defined the professional speculator as one who treats trading as a rigorous business, adhering strictly to a predefined set of rules regardless of the noise, the excitement, or the internal emotional turmoil. Livermore understood that the most crucial element in speculation is the control of the self. The integration of these 15 principles transforms the speculator from a reactive gambler into a proactive market professional, focused on maximizing return while strictly controlling downside risk. They provide a complete operational manual, covering everything from initial trend identification, principles 1 to 5, and capital protection, principles 6 to 10, to the essential psychological framework, principles 11 to 15. Success is found in the synthesis of these rules, where failure in one area compromises the entire structure. Your commitment now must be to integrate these principles into a personalized, written trading plan that defines your entry criteria, stop-loss levels, and profit-taking signals with absolute precision. Do not merely read these rules. Internalize them until they become reflexive habits, replacing innate human greed and fear with mechanical discipline. The professional speculator is defined by the unwavering consistency with which they execute their plan, especially when the market environment is stressful. Livermore's final lesson is that the money is made by sitting, waiting, and thinking, not by constantly trading. Master the trend, manage your risk ruthlessly, and control your emotions, and you will have adopted the enduring methodology of the legendary speculator. Apply these 15 laws, and you transition from hoping for success to systematically earning it. If you found the profound psychological insights and strategic discipline of Jesse Livermore compelling, there is only one definitive source to deepen your understanding: the classic text that immortalized his strategies. We are referring to the newly updated edition of Reminiscences of a Stock Operator by Edwin Lefebvre. This is not just a historical account. It is the ultimate psychological case study and a timeless masterclass in market discipline. The new edition transforms Livermore's experiences into actionable, practical lessons for contemporary traders by including unique, dedicated commentary and analysis for every single chapter. It bridges the gap between the trading floors of the early 20th century and the digital markets of today, showing precisely how Livermore's psychological struggles and strategic breakthroughs apply to your current trades. You need this enhanced version to truly grasp the depth of the principles we discussed today, turning historical narrative into modern trading advantage. Secure your copy of the new edition of Reminiscences of a Stock Operator now. The purchase link is provided directly below in the description.